Joining me right now is the president of the St. Louis Federal Reserve Bank, President James Bullard. James, it's great to see you this morning. Welcome back. Thanks very much for being here.
Great to be here, Maria.
James, give us your take on the state of the economy. We know that we're looking at an improving situation. What do you expect for the rest of the year?
You know, Maria, I think we've made substantial progress from December of last year. At that time, the FOMC was expecting 4% real growth in 2021. We're now expecting 7% real growth in 2021, faster than China typically grows. We were expecting inflation to be 1.8% on our preferred measure. We're now expecting core PCE inflation to be 3% for all of 2021 and headline inflation to be 3.4%. And labor markets have improved far more rapidly than would have been projected. So I think we're in much better position than we might have expected 6 months ago. U.S. economy is really roaring forward here coming out of this pandemic. And we're getting bottlenecks and inflation concerns. And I think we're going to have to be attentive to those concerns.
Yeah, I mean, we've been attentive to some of the big moves within food and even oil. We just had an interview with one money manager who pointed to oil as a good way to look at inflation. What is your sense of where we are in terms of the energy markets right here? Do you worry that the price of oil rising, some expectations have it all the way up to $100 a barrel later on this year, does that serve as a slowdown of economic growth in your view?
It's been a double-edged sword for the U.S. because of fracking production, so I'm not quite sure where this is going to go, but I would just encourage everyone to look at the oil market as a barometer of global demand. And so what's happening is you're bringing the pandemic under control, certainly in the U.S. probably first, and then other countries later, and that's ramping up demand across the world, and so you're seeing that reflected in the oil price. So I really think the U.S. will be a leader here, and we've got probably more reopening to come in the second half of this year with schools being fully back in session, a lot of parents able to go back to work. And I think we'll get a tailwind from Europe coming behind us, which will have reopening. They're looking good for the second half of 2021. And then emerging markets also coming behind that as we continue to get this pandemic under control across the world. So we're really looking at a booming U.S. economy at this point.
Yeah, and I bring up oil because I wonder how closely you're watching that in this whole inflationary picture. We've heard from you and your colleagues now a couple of times on inflation, and I know that policymakers are split over how severe it is. Most say it's temporary. Your take on this, James, what causes one to believe that these spikes in inflation are just transitory? Why would they just be temporary?
I think part of it is temporary. Certainly, you've got markets that are under a lot of pressure here. I would say this economy is not really designed to be growing at 7%. That isn't the way the business community has set this up, and their supply chains are very strained here, and they're running out of product in certain places. And what's the natural response of the market? Well, prices go up in that circumstance. Now, those are things that I don't think are as easy to fix as people think. So I think we're going to see continuing price pressure well into 2022. And I think the risk here for us policymakers is that there's still upside risk to inflation. Even though we're going to have higher inflation this year, it could even be higher than we anticipated, and it could be higher than we anticipated next year. We have to be ready for that situation.
Yeah, James, what an incredible period we're coming off of. I mean, this pandemic and this lockdown, now we're getting back and seeing this reopening. You say there's more of the reopening to happen. I totally understand that. But, James, do you see a structural change in the way that we're operating, the way the economy will evolve, given the fact that people have changed their approach to work, some looking for a hybrid situation, working home and in the office? How do you see things changing after this incredible year that we've all participated in?
Well, this is rapidly evolving, and I do think that productivity may shift up to a higher growth rate now. We've been in a low growth rate for productivity for a long time. One thing that a crisis does is it forces you to experiment with new ideas and new technology. Some of that will have lasting impact on the productivity growth rate. U.S. productivity did grow at a very rapid rate between 1995 and 2005. We could go back to that kind of level. That would be very good news for the U.S. economy. It would suggest much faster growth going forward. So I do think that that's a possibility. If you look at the data on this, it's very volatile right now, but it does suggest that maybe we're tending in that direction.
Yeah, it's an interesting point because we're talking so much about the back and forth between the White House and Congress regarding the unemployment benefits, what that means in terms of the jobs market. But you're saying what we've seen is productivity actually ramping up, and you're expecting productivity to continue to improve. Is that right?
Yeah, of course, nobody knows. I probably don't know any better than anyone else. But just looking at the data, it is much better than it has been. And just, I think, based on anecdotes, talking to people around the 8th District here and across the country, it does seem like productivity may be moving higher. So that would mean the general level of interest rates would be somewhat higher than what we've experienced in the past. I think that has to be a factor in monetary policy as we go forward. And the other thing I would just stress here is this is a fast-moving situation. When we came out of the last crisis in 2007 to 2009, it was all slow motion for a decade. Hardly, the U.S. economy did not grow rapidly. The labor market did not improve rapidly. It took years. This is all happening very, very quickly here. U.S. GDP is passing the pre-pandemic peak as I'm speaking here. And not only that, we're going to go past the pre-pandemic trend for GDP probably later this year or early next year. So I think we've got to change our mindset here about how fast things are moving and probably how fast policymakers have to react to the situation.
Yeah, and I think I certainly appreciate, and I think the market appreciates the fact that the Federal Reserve has become more transparent, speaking English, about what's going on. It's a difference from the days when I was covering Alan Greenspan at the wheel years ago. He would talk, and you didn't really know what he was saying. But James, there's a real expectation that this conversation around tapering, around a change in policy, picks up speed around Jackson Hole and perhaps into 2022. Tell me what happens now in terms of the conversation. Are you expecting that we will get more clarity in terms of the Fed's policy expectations later on in this summer when you have your meeting in Jackson Hole?
I was just reminded of that anecdote in Alan Greenspan's book, The Age of Turbulence, where he said he had to ask Andrea Mitchell 3 times to marry him because the first 2 times she didn't understand what he was saying.
Exactly. Exactly. That was very funny. Yeah.
We've come a long way on transparency, and I would credit leadership of former chairs on that, and I think we can continue to do better on that dimension. But as far as this taper discussion, Yeah, I do think we need to get moving here. We have a booming housing market. It's not at all clear that we want to be feeding into an incipient housing bubble. We have really a rapid pace of purchases in an economy that's already growing 7% and is fully recovered in GDP terms from the pre-pandemic level to the pre-pandemic level. So I think sooner is better on tapering. I think markets are ready for it. We've got really good results and coming out of this pandemic on our mandate, and we're going to continue to get good jobs reports. I don't know what's going to happen tomorrow, but as we go through the rest of this year, we're going to continue to see improvement in the labor market. So I do think it's important to move on this debate now.
James, any thoughts on how severe this housing boom has become? I think certainly home ownership and buying a home is getting harder and harder with prices moving up. Does anything feel to you like you were seeing in 2006 right now?
Well, that's the concern. We really got burned by letting the housing market get out of control in the mid-2000s, and it really came back to bite us. And so I don't think we want to be, as policymakers, we don't want to be feeding into that, any processes like that. And, some things that you're seeing are worrisome. You've got outside investors, let's say, coming up and snapping up houses and thinking they're going to either flip them or rent them out. And you've got very limited supply here. People are holding on to their houses. And you've got a shift in demand as people think about, maybe the suburbs are a better option coming out of the pandemic than they thought before. And so lots of things are going on here. But it's one thing to have a meme stock, trading, and we're all scratching our heads about it. But to have the housing market be mispriced is very concerning because that's 40% of the U.S. capital stock. So that's really a fundamental piece of the economy as opposed to an individual stock.
It's a great point, and I'm so happy we hit on it. James, it's great to see you this morning. Thanks very much. Come back soon, sir. Thank you, sir.
All right. Thanks a lot, Maria. Always great to be here.